Hello, and thank you for joining us. Today we're here to help you understand what your options are with respect to your pension after a job loss. Our agenda today covers general information about job loss and break-in service. We'll also break down your pension options based on age. It's a lot of information, so if you have any questions, please jot them down so you can ask our pension specialist at the end of the presentation. Your pension benefit is to provide you with a lifetime pension in retirement, so the longer you participate, the greater your pension is. When you are laid off, contributions to your pension are no longer made, so in this presentation, we'll go over your options. We also recommend that you speak to an independent financial advisor to help you make the best decision for your financial situation. Your monthly pension income in retirement is calculated by multiplying the years of credited service by the benefit rate in effect for each year. The types of hours in the plan for which you receive credited service are funded and unfunded hours. You and your employer both pay contributions on funded hours. Some examples beside your working hours are leaves such as parental leave and jury duty leave. Unfunded hours are those for which you and your employer do not pay contributions, but which you still receive credited service for. Examples are layoff and disability hours. Excess hours can only be used to bring you up to a full year of service in years you don't reach the hours threshold applicable to those years, including the year you retire. We'll explain how excess hours can be used later in this presentation. You break service with the plan when you do not work at least 350 covered hours in 2 consecutive calendar years with a participating employer. When this happens, all credited service you have earned changes from active service to deferred service, and you become a deferred plan member. Breaks in service are calculated on a calendar year basis ending December 31st. The first example here shows you would break service December 31st, 2026 if you accumulate 200 covered hours in 2025 and no hours in 2026. Following this break-in service, the plan office would send you a break-in service package in March of 2027. The second example shows a member who remains active till the end of 2026 and has a total of 700 covered hours in a 2 calendar year period. It's important to note that if you've recently been laid off, you may not break service for some time. Excess hours can be used up until the break-in service, but cannot be used to prevent a break-in service. If a member loses their job due to a closure or curtailment, members will receive up to 200 layoff hours that may be used towards preventing a break-in service within the 2 consecutive calendar years. Members receive 40 hours up to 5 weeks for a maximum of 200 layoff hours. The break-in service options will depend on the member's age at the time of the break. Involuntary job loss is when you lose your job due to economic or environmental factors such as downsizing or technological change, if your job is eliminated or if your employer permanently closes its operation. There are provisions in the pension plan to help protect members' pensions after an involuntary job loss, which we will explain in a moment. If you are 60 years of age or older, you can apply for your pension immediately and receive 100% of your pension benefit. If you have excess hours, you can defer your retirement to use up your excess hours up to 3,600 hours maximum until you break service under the 350-hour rule. It's important to remember that you need to contact the plan office 3 months before you wish to start your pension. If you're an active member and have an involuntary job loss after reaching the age of 55, you will not break service from the plan and will remain an active member. You will be entitled to the subsidized early retirement benefit beginning at age 55 and will be able to receive 100% of your pension if you retire at age 60. Please note, you must be at least 55 and no older than 59 on the date of the involuntary job loss to qualify as an active member for the early subsidized retirement benefit. With the subsidized early retirement benefit, you can see that between the age of 55 and 60, you would be receiving between 82% and 100% of your pension based on your age and status. Other factors will affect the amount you receive, such as the pension option you choose and whether or not you have a spouse or beneficiary. At the age of 60, you are able to receive 100% of your pension. You may also use excess hours that were accrued in the past so that you can increase your credited service until the date that all of your excess hours have been used, or the date you choose to retire, or your 65th birthday, whichever comes first. Here's how it works. This member is not returning to work for a participating employer. They are 56 years old and have 20 years of credited service with 9,000 excess hours at the end of 2023. Without the involuntary job loss provision, they would break service December 31st, 2025 and could only use a maximum of 3,600 excess hours towards their pension. However, in the second example, with the involuntary job loss provision, you can see by choosing to retire at age 61, they've increased their credited service to 25 years by using 9,000 of their excess hours and increased their pension in retirement. We encourage you to contact the pension team to see if this applies to your specific situation. If you're under age 55 when you break service, you have a few options depending on whether or not you return to work with a participating employer because of involuntary job loss. There are approximately 400 participating employers in the plan. If you find other work in the industry with a participating employer within 2 years, you will remain active in the plan. Staying in the plan allows you to continue to build your lifetime pension in retirement. Active service also qualifies for the subsidized early retirement benefit, and you may be eligible for future plan improvements. If you return to work for a participating employer, you may be able to upgrade the status of your credited service from deferred service back to active service. If you do not return to work with a participating employer, all credited service earned before your break-in service date changes from active service to deferred service, and you become a deferred plan member. We'll go over these two scenarios in more detail now. If you return to work with a participating employer within 3 years of your break-in service, you may qualify for the deferred service upgrade, which is formerly called the 2-for-1. To be eligible for the service upgrade, you must satisfy all of the conditions that are listed on this slide. As shown on the previous slide, you need to return to work for a participating employer within 3 years of your break-in service. For each full year you work, you can upgrade 2 years of deferred service. Here's an example. At the time of their break-in service, this member had 15 years of deferred, which you can see on the left. They returned to work for a participating employer and worked for 4 full years. Because they satisfied all of the conditions shown on the previous slide, they can upgrade 8 years of deferred service to active service. Now they have 12 years of active service and their deferred service has reduced to 7 years, which is shown on the right. The total amount of their credited service earned prior to the break-in service doesn't change, only the status of their credited service. By continuing to work full years of service, your total deferred service will decrease and your total active service will increase. If you are under age 55 when you break service with the plan, all credited service earned leading up to the break-in service date changes from active service to deferred service, and you become a deferred plan member. You have 2 options. Leave your pension in the plan and receive a monthly pension when you retire, or, following your break-in service, receive a termination lump sum payout and end your membership in the plan. When you leave your pension in the plan, you are entitled to a lifetime pension at the normal retirement age of 65, or you can take a reduced pension as early as age 55. Keeping your benefit in the plan has advantages. When you receive a pension for your lifetime, you won't risk outliving your benefits, and you can count on receiving the same pension income every month. If you return to work for a participating employer, you will continue to build your pension and may be eligible for future negotiated improvements and benefit upgrades. And at retirement, you will have the option of providing coverage for your spouse or beneficiary so they are financially protected should they outlive you. If you die before you start to collect your pension, your surviving spouse, beneficiary, or estate will also receive a benefit from the plan. If you choose not to receive a pension from the plan in retirement, you may choose to transfer your lump sum benefit out of the plan. It's important to remember that if you choose this option, you no longer qualify for the involuntary job loss provision and you will no longer be considered a plan member. This means you will not be eligible to receive any future pension improvements or post-retirement benefit increases. In addition, your spouse or beneficiary will not be eligible to receive a benefit from the plan after your death. If you choose to leave the plan, your lump sum benefit is calculated as the amount of money that, if invested today and held until you were 65 years old, would be expected to provide the same monthly pension that you were entitled to receive from the plan in retirement. If your lump sum benefit is over the legislated threshold of $13,700, it is considered locked in until you reach age 55. It can be transferred out of the plan, but only into another locked-in retirement vehicle. This legislated threshold changes annually. There are several payment options and legislated provisions that may apply to how your benefit is paid, and you can obtain this information by contacting the plan office. If you are receiving a long-term disability benefit from the IWA Forest Industry Ltd plan and are considered totally and permanently disabled, your pension is protected by the involuntary job loss provision. With the involuntary job loss provision, you will continue to receive disability credits while on LTD. You will not break service and your pension will continue to grow. As an active member, you would retire as early as age 60 with 100% of your pension. All pensions are payable for your lifetime. The difference is in the beneficiary coverage. Your option after a job loss differ according to your age. If you are 60 or over, you can immediately apply to receive your pension without any age reductions or delay your retirement date to utilize more of your excess hours. As an active member between the ages of 55 and 59, you can receive a subsidized early retirement pension or wait until you are 60 to collect an unreduced pension, or delay your retirement further to utilize more of your excess hours. If you are 55 or under, you can receive your pension when you break service or reach retirement age, whichever comes first. If you retire early, you will receive the actuarial equivalent based on your age. You can also receive a termination lump sum payout and end your membership in the plan. Please note, you need to be under the age of 55 at the time of your break in service. The normal age of retirement for this plan is 65. You have the option, however, of retiring as early as age 55. All active members are entitled to the subsidized early retirement benefit. If you are an active member between the ages of 55 and 65, you are eligible to receive between 82 and 100% of your pension for the duration of your retirement. See the left side of this illustration. If you are a deferred member, you have the option of receiving 100% of your pension from the plan beginning at the age of 65, or an actuarial reduced pension as early as the age 55. The reduced payment is because you are collecting your pension for a longer period of time. See the right side of this illustration. Deferred members over 65 should apply immediately as the pension amount does not increase and the pension start date cannot be backdated. According to legislation, the latest date you can retire is December 1st of the year you turn age 71. Continuing to work past age 71 will not impact your pension. While the illustration above shows the percentage you will qualify for based on your age and status, other factors such as the option you choose and whether or not you have a spouse or beneficiary will affect the amount you receive. When you apply for your pension, there are several options for you to choose from. The option you choose and whether or not you have a spouse or beneficiary will affect the amount you receive. The greater the spousal coverage you choose, the lower your monthly pension payments will be. This is because your pension payments will need to cover your lifetime and the lifetime of your spouse. Should your spouse decide to waive their legal right to lifetime survivor benefit coverage, they will need to sign a waiver prior to your death. If you do not have a spouse, or if your spouse waives the survivor benefit, you may designate who will receive the death benefit. You may designate more than one person. For example, you can name your children as beneficiaries. If you do not have a spouse or beneficiary, you can select a straight life option. In a nutshell, here are the three basic types of pension options. There are a few joint and survivor options which provide lifetime coverage for both you and your spouse should your spouse outlive you. The guaranteed options provide lifetime coverage for you and may provide limited coverage for your spouse or beneficiaries based on the guaranteed date. The straight life option is only payable for your lifetime and does not provide beneficiary coverage. Within these options, there are a few sub-options which we'll describe in more detail next. The joint and survivor option is only available for members who have a spouse. If you do not have a spouse, you cannot select this option. With this option, your spouse will continue to receive a monthly pension after your death. If your spouse dies before you do, there will be no further benefits from the plan following your death. It's important to note that if you choose a joint and survivor option and then divorce or separate from your spouse, you cannot change your beneficiary. This is a legislative provision. Your spouse can choose to waive their right to a lifetime survivor pension. However, they would need to sign and submit a waiver. This joint and survivor option also offers a 10-year guarantee. As soon as you receive your first pension payment, the clock starts ticking on the 10-year guarantee period. If you die before the 10-year guarantee period ends, your spouse will receive monthly payments equal to 100% of your lifetime pension for the remainder of the guarantee period. When the guarantee period ends, your spouse's monthly payment will be reduced to 60% of your lifetime pension. With the guaranteed options, you receive your monthly pension for your lifetime with a guaranteed option for a period of time which you select. If your named beneficiary passes away before the guaranteed period expires, you must elect another beneficiary. If you both pass away at the same time, say as the result of an accident, we would pay the remaining payments of that guaranteed period to your estate. The most important thing to remember with any of these guaranteed options is that if you pass away after the guaranteed period expires, no further benefits are payable. For example, if you select life with a 15-year guarantee and live for 20 years following your retirement, nothing further is payable to your beneficiary or estate. The straight life option is just that. It's payable for as long as you live, but offers no beneficiary coverage whatsoever. If you pass away after receiving only one payment, nothing further will be payable to your estate or beneficiaries. It's important to note that you need to apply for your pension before you receive it. Your pension does not automatically start. At least 3 months before you wish to apply for your pension benefit, you should contact the plan office to request a retirement application package. The plan office will provide you with a pension estimate and application package. Please remember that your pension is considered taxable income. We will withhold taxes based on the information provided on your TD1 form. The government provides additional retirement benefits including the Canadian Pension Plan, CPP, Old Age Security, OAS, and Guaranteed Income Supplement, GIS, for individuals with a lower income. You can speak to a Service Canada representative for more information and a full estimate of your combined monthly pension. If you have any questions specific to your situation or would like guidance on completing any forms, contact the plan office and we will be happy to help you. A reminder that we do not, however, provide any financial or legal advice. We encourage members to check our website regularly for any updates and events like this one, to download pension and LTD forms, read annual reports, newsletters, and plan booklets. To learn more about your pension, take a look at our pension videos. These videos go into more depth about topics such as your pension options, applying for your pension, beneficiary coverage, earning service, and breaking service. Each video is only 2 to 3 minutes long and is full of great information. We do our best to provide accurate information, but not every rule or situation is covered. This presentation is not a substitute for the plan text, which is available by contacting the plan office. If there are any inconsistencies between this presentation and the plan text will always govern.